Hey traders, this is Alex, and this is a trade I made today on Exxon Mobil. And what I'm trying to do is to capture some dividends. Exxon had some earnings last week and actually were positive, but we're kind of the top range of the Bollinger Band. So if it goes down, then I might get a sign. What I did is I sold the ATM Put, the 74.50 puts, and if it goes down, then I'll have to buy those stocks and get the assignments. If it go up, then I'll keep the premium and I'll make money that way. Exxon Mobil pays 82 cents per share quarterly, and the ex-dividend date is this Friday. So this is a mistake I actually did after I made the trade. I realized that I should have the stock before this Friday. So what I'm gonna do is on Thursday, if I'm winning, then I am going to actually buy the stock and close the position and use it just to reduce my basis. But anyway, this is the dividend paid is next month on the 11th, and the yearly dividend will be $3.28 per share. So that's 82 cents multiplied by 4, and that will give us a yield of 4.4%. But if I sell the ATM Put, I sold it for $1.02. I will increase the premium plus the dividend paid for the year to around $4.30, and that will give me a yield of over 5%. So I'm improving the yield I'm getting on that trade. So there is a good thing and bad thing about this kind of trade. This is very safe trade, so that's one of the benefits. It's very high probability trade in terms of you'll get those dividends and get to buy the stock at a discount. So that's what I'm trying to do. However, it's not efficient in terms of capital. So let's take a look. Here, this is the trade that I made. This is the one of my accounts on Thinkorswim platform, and if we go to the trade page, here we can see the Exxon Mobil, the yield 4.38%, the dividend, the ex-dividend date. So I have to I need to have the assignment before the date, so that's why it's not really it wasn't efficient in this particular trade. However, I did made that same trade in other stocks. If we go back again to here and some of the dividend stocks that I have, I did it on Target, on Johnson & Johnson, and Edison also made that same strategy. And what I'm trying to do is trying to be efficient with the capital that I'm not using for options. So what I'm usually using around 30% of my capital on options, and the rest I put it on a risk-free account that yield me around 2.3%. So if I can increase that yield, then I'll even improve my returns for the whole portfolio. So that's what I'm doing and testing right now. So I sold this at the money put, the 74.50 for $1.02. So I'm making a little bit of money right now. If we go back again, we're making $92 right now. And what I meant about the not efficient part, I do it in this account because this is a portfolio margin account, and what that means is that I get more leverage, so I'm using less capital to do this trade. For example, right now I'm using $5,500 in this trade. This is the buying power effect. You can also see it again here, the buying power effect that I'm using for this trade. And if we compare it with the Tastyworks, one of my Tastyworks accounts, let's go here. This is a Tastyworks account, and they don't have portfolio margin yet, so it won't be as efficient. First, when I get to buy if I get assigned and I buy it, I have to use over $30,000 to have. I did 5 contracts, so that's 500 stocks, and I'll be using over $30,000 for this trade. And if I'm gonna do the options, if I do review and send, in this particular platform with no portfolio margin, then I'll be using $7,000, comparing that to the $5,000 that I'll be using in this other account. And if I get assigned, what the portfolio margin account does is that it compares all the positions that you have in your portfolio and distribute the risk accordingly. So I will be using less capital in that sense, less than the $30,000. So that's why I'm doing it in this particular account. The only bad thing is that to have a portfolio margin account, you need an account of over $100,000, like 110 or 125, depending on the broker that you have. So not everybody can do this. Anyway, the important thing that I wanted to show you is that this is a way that you can get to buy stocks at a discount, and once if I get assigned, then I can continue and sell some calls to keep reducing my basis. So I'm getting 82 cents as a dividend. I already, if I did it right now, I will get basically the same amount for the dividends in just 4 days to expiration. So that's awesome, basically. And if I get assigned, then I can continue and sell some calls, make it a cover call, and that won't be using any more capital, but I can still get more premium. So let's say if I decide to do this 39 days to expiration call, or in this case on the 11th, I will get the dividend, right? So if I decide to sell the 75 at the money call, then I'll be receiving 126 from between 126 and 28. So this is 128 will be the mid price, and let's say if I do 5, then I'll get an additional over $500 in addition, basically over $600. In less than a month, or just about a month, I will get the premium of the put, the dividend, the 82 cents dividend, and then the premium of the call. So if it continue to go up, then I can close it and make that quick profit. And if it goes down, I can continue to roll down the put, the call, or even add a put and make it a strangle. So hopefully this was helpful. As soon as I get assigned or continue with the trade, I might continue to update this trade. I also will continue to update it here in this trading view. So if you want to see how it goes, you can come here and check it out. Well, thank you very much, and if you like this video, don't forget to subscribe and hit the bell button and like it. Thank you very much.